Hello, everyone. I'm Finn Murphy, a corporate partner with Morgan Lewis with a focus on securities law and the shipping industry. It's my privilege to moderate this panel and lead a discussion about the capital markets and the shipping industry. With our distinguished group of panelists to my left. This topic, I think, goes right to the core of this conference and is of great interest to all attendees. So I'll briefly introduce our distinguished panel and then get started. To my immediate left is Christa Volpicelli, who heads up shipping investment banking at Citi. Erik Helberg, who does the same at Clarksons Platou. Todd Wilson, who does the same at Jefferies. Erik Schless, Managing Director at Wells Fargo and Head of Global Shipping. And Joe Brantuk, our non-shipping guy, who heads up IPO listings at the NASDAQ. And will give us a good perspective on the overall IPO market out there. So with that, I thought I would kick things off with a topic that's always top of mind, which is kind of how receptive are the markets to shipping issuance right now. I think we have the S&P 500 and the Dow near all-time highs. Sentiment in the shipping industry seems to be improving a little bit, at least in some sectors, but still challenging to get deals done. But maybe, Christa, you want to kick things off on your perspective on how open the markets are? And I imagine that might be a different answer for a currently public company and an IPO.
Sure, happy to do so. Thanks, Finn. And you are right, it's a different answer for an existing public company and somebody trying to tap the markets for the first time. Last year, so 2016, was our slowest year in terms of U.S. issuance of shipping equity since 2009. And it was the first year since 2009 that we saw no IPOs coming to New York in the shipping sector. So the last IPO that was done was mid-2015. 2015, we saw 2 tanker companies listed here in New York. And the lack of the IPOs has been a combination of general market backdrop in the sectors and where the existing public companies have been trading across the board. Because any company entering the public markets for the first time, investors are going to look at where the existing public companies are trading and then look to price it at a discount to that. The existing public companies, I would say it has been a slightly different tone. There is absolutely investor demand there. Again, it is where the current prices are trading. And we are still in a scenario where in the tanker sector, you've got companies straddling NAV, most companies trading below NAV. Dry bulk has taken off recently given some of the momentum in the sector, but many companies are challenging for investors to still invest in today. We've started to see things come back a bit in the maritime MLP sector. So over the last 6 months, we have actually raised a reasonable amount, an increasing amount of equity for many of the existing U.S. listed companies. We've seen good demand from investors coming into those books. We've seen demand from both existing investors as well as new investors coming into those names. So there is capital there, but it is a question of cost of capital from the perspective of the issuers.
Erik, do you want to give your perspective on that and maybe what we're seeing in the Norwegian markets as well?
Yeah, I would echo what Christa said. Most of the shipping markets have been, challenging. LPG, dry bulk, tankers with kind of a softer outlook for 2017, kind of haven't really been there to support a lot of activity. So 16 was a lot about strengthening balance sheet for the dry bulk players. But obviously now, there's much more optimism back. We're seeing kind of a light of the tunnel. The yard situation and the ability to build this market to death is always there. But I think it's quite encouraging to see that in 2011, which was the peak delivery from yards, you had 180 yards that delivered more than 1 ship, and that number is now down to 100. The number of yards that delivered more than 5 ships is 27. So there's even though there's capacity, it's definitely kind of being taken out to a bigger degree in the market, which obviously bodes well for hopefully less supply coming in. And there's there's encouraging signs from China that they're being more active, and we're seeing that obviously in the dry bulk market. So I think, in general, equity market optimism is back, and we've seen that so far this year.
Great. And what are investors, and maybe I'll send this to Todd, just keep going down the panel. What are investors looking for beyond sector and price? What's kind of characteristics of a company or a deal helps get it over the line?
Well, I think value appreciation, right? So I think you've seen a lot of investors in the last several years not make money investing in shipping. So I think where investors are looking to play right now, and you've seen this in the dry bulk space, not only with the recapitalizations that were mentioned earlier, but also with growth financing, is investors want to see some upside, right? And so if you had, dry bulk, for example, until recently was trading still at all-time lows, I think investors started to see, if the global macroeconomy, continues to expand, and the U.S., we'll see what happens with the U.S. politically, but if the U.S. continues to grow and maybe accelerate growth, I think investors were looking at shipping and in particular dry bulk as a value opportunity, right? It was trading at the bottom, and it's something that could benefit from, an increased global economy. So I think investors were really looking at upside rather than, a specific project or something like that in mind.
Hey, Erik, what are you seeing in this regard?
Well, I think what I would say is that there has been a real choice. We have seen increasingly that investors will pick one or two companies within a sector, and based really on the liquidity of the stock, the strength of the balance sheet, market cap to a certain degree, and that's how they're going to play that sector. I think that as there is more tolerance for risk in shipping, because I still think that people are recovering from the wounds that they had as stocks got really hammered, you will see it return to maybe the next tier of shipping companies. But I do think that with the passage of time, size and liquidity and strength of balance sheet have become more important, and the ability to just kind of throw a small fleet out there and hope that it'll do well in the public market is going to become more challenging, not because there are huge economies of scale in operating a large fleet, but because that gives rise to that liquidity and market cap that I discussed earlier.
And maybe, Christa, taking off of what Todd said, do you see a focus on kind of the use of proceeds between growth capital and versus return of capital via dividends and stock buybacks, or how important is that to the calculus for investors?
Sure. I think Todd said it well when he talks about value appreciation, because ultimately any equity investor is looking for growth in their equity investment. And so that can come from either buying assets cheaply and having those assets increase in value and paying out cash flows over time, or it can come about by investing those proceeds in growing the company. In sectors that are less cyclical, investing capital towards growth projects and continuing to grow the company is a very traditional way to drive value to shareholders. In shipping, it's all about finding the right time to buy or sell assets. So I would say there's no one recipe. In general, if you are raising capital and there is a specified use of proceeds, that's usually better. It's usually a little bit easier. But we have seen cases where we've been able to raise capital for management teams who have had a track record of deploying proceeds successfully. And so there's an element of trust in a certain management team and institution, if you will, where investors believe that it will be raised over time. But given that you've had many investors lose money in shipping, I do think that investors are quite careful in terms of understanding how a particular company will be utilizing that equity capital.
Before we get too far into the weeds on shipping-specific questions, maybe Joe, could you speak to just what we're seeing in the overall IPO market? I think in the broader market, we've certainly seen 2017 get off to a better start than 2016. but still not as robust as in years past. But kind of what are you kind of seeing there, and what are investors focused on more broadly?
Yeah, I think that's right, and thank you. 2000 and you take a look at 2016, the market did only 123 IPOs. If you take a look at that to historical levels, it was incredibly muted. But we felt a lot better coming in 2017, where we felt that the ingredients were there for a much more robust IPO environment. You had very low volatility. Equity markets were at an all-time high, but still, companies are still having a little bit of difficulty getting out. In terms of sectors, generally speaking, there's three main sectors: financials, healthcare, and I would say technology. And those three sectors have really led the way, I would say, probably for the past 2, if not 3 years. But if we also take a look at returns, last year, IPOs returned on average 23%, so clearly outperforming the Dow, S&P, and NASDAQ. Even with that backdrop, the buy side is having a difficult time pulling the trigger. They're being certainly a lot more selective, even in some of these bigger technology names, and so it's an interesting dynamic. So year to date, we've only had 27 IPOs. So just to put that in perspective of where that was last year, we had 9 at this time last year. So we are seeing the numbers increase, but certainly below our expectation.
So maybe I'll throw this one to Erik Schless. What do you think we need to see come together to facilitate more IPOs in general and shipping in particular?
Yeah, I think people need to make more money. They haven't made enough money in shipping stocks yet. And it's very interesting. If you look at, if you start your timeline from the election of Trump as president, shipping stocks have done very well. I think though that people are still, there are a lot of people who are still in the bunker. There were a lot of energy investors who invested in shipping as a proxy for the energy market, who, with the decline of energy prices, pulled out. And so I think there just needs to be, if you will, people need to feel as if the momentum's in front of them, to the theme that Todd and Christa both mentioned, that in fact, the stage is set to make money over a relatively long term, because these are not stocks that are easy to get out of once you're in them.
I think I would add, we keep talking about investors, rightfully so, because they ultimately price the IPO, but there also have to be sellers, right? And so I think, look, it's no secret who the companies are that were dying essentially to go public over the last few years. I'm not so sure they're dying to go public right now, right? A lot of asset values are down from where they bought in at, and you're going to take a discount to that, right? So could there be an IPO this year at a price? Yes, but there has to be a willing seller at that price too. So to me, what could be more interesting is someone who has a private company who has bought assets recently over the last 12 to 18 months, say, where maybe they could take a discount to today's asset values and still be selling at a premium to where they bought in at. I think that's another key we haven't talked about a lot is, are there really companies lining up to go public right now? And I mean, I'm sure if I said you could go public at 200% of asset value, there would be, but it's always at a price.
But ultimately, for an IPO to be successful, you need to offer something to the market, which is not there today. Something that investors could invest in that they can't find in the market. So if you have listed companies that are, well managed, they've got good ships, nice fleets, and are trading at, let's call it, relatively attractive levels, it's going to be very difficult to come with a newcomer, to compete against that. Obviously, you compete against price. So there needs to be an opportunity, either that the market recovers, as we discussed, and valuations come up sharply, then there might be an opportunity. Or if there's something, there's an edge you have in terms of chartering strategy or cash flows, etc., that is not there, then there could be an opportunity. But at the end of the day, you need to offer something which is not there.
I guess I would add one more point, which was alluded to previously, but perhaps not mentioned here. In terms of making an IPO successful today, I think Erik Schless talked about the benefits and importance of scale and size in the public markets in terms of having a company that's big enough to develop a proper investor base that can trade in and out of a security. So if you look at a number of companies that maybe were IPO hopefuls before, I think that some level of M&A and consolidation could absolutely help another company get public. Now, we all know the challenges to that within this industry. But as Erik said, you have to offer something differentiated to the market. And if you are in the absence of a very strong market and a strong backdrop. So I do think that is one thing that could help.
Mm-hmm. What do you think about the recent Quintana Golden Ocean deal was a case of perhaps a company in Quintana getting a liquid stock through M&A as opposed to a listing, given the challenges there. Do you think we'll see more of that, or it's kind of been notoriously difficult in the shipping industry to execute on M&A?
Yeah, I think that was healthy, and I think it was rewarded, and I don't think it was rewarded by the market. That should encourage people to do it. It doesn't overcome the difficulties that we all know exist, but it does demonstrate that if you do it, you get paid for it, and hopefully that will drive some decision-making.
In terms of what we have seen, I think a number of panelists mentioned there has been a fair amount of equity capital raised in the last few months and some improvement in sentiment. What types of offerings have been successful recently in terms of both marketing strategies and the products being offered? It seems like they've seen a variety of products trying to tap different pools of potential investors. But maybe Todd, do you want to take that initially?
Sure. Look, I think a lot of the deals that have been successful have been backed by current shareholders. Somebody mentioned earlier, existing investors are investing in these deals. They're almost, in a way, it's almost a rights offering where everybody's defending their turf. They don't want to be diluted at these prices. And then I think, so once everybody got fixed, right, so I'm talking specifically about the dry bulk companies, I think you're now seeing some growth capital deals based along what I said earlier, where investors believe in some upside now. And so if you have a company that's fixed and you've limited the downside because you've provided a runway with capital, now if you can raise more capital to grow and be accretive to the earnings story, I think investors are willing to line up for that.
I think Todd is right. I think what's been interesting to see is that the capital raises we've seen have been supported obviously by the existing shareholders as well. But we've seen a new move from the long funds to move into these names because they're comfortable with entering at these levels. If you go into a company that is raising capital so that you keep that strong optionality alive by giving enough liquidity, basically withstand the potential 12 or 18 months low market in a historical low environment. I mean, if you look at dry bulk values that we've seen as of late, and you go back the last 25 years, there's basically been, there has never been one single 5-year period where if you invested at those levels, you didn't make money. Actually, 99 out of 100 cases. So, it's a very attractive risk reward. And if you go into a platform that has, a strong enough balance sheet to withstand another weak period, weaker than we've ever seen before, then, I think that's the value proposition they're seeing.
Erik, what are you saying in terms of what's attracting investors, what's working for?
Yeah, I think there is still. I agree that the dry bulk sector has made really a strong recovery. I think the belief is there's still runway in front of it, which goes to the comments that were made earlier. I think there's a lot of whether it was Korea lines or Hanjin or whatever, there's a lot of focus on counterparty risk. And I think that there is also there are two trends that I see. One is, obviously, the vessel supply story is a very, very important one, and that seems as if it's on a good path. The shipyards there are fewer shipyards. There's, some of them are not supported by the government now, they're supported by banks, so one would think that there would be commercial decisions made as opposed to social decisions. And then I think, so that all plays well, and that's in large measure why I think the dry bulk story has been playing well. I think that in addition to that, you still have pockets of the shipping sector like LNG where people see a really long-term move toward that type of commerce that if you can just get it about right on the entry level, you have a lot of runway in front of you.
I think Erik is right about the way that investors have looked at the supply side. I asked some of the most successful ship owners of this time why they were buying dry bulk vessels 6 months ago. And they said, well, hey, what do you think? And I started talking about China, and they said, forget it, Erik, forget it. It's nothing about demand. We don't know what demand is going to be. It's supply. It's supply. It's never been cheaper, and you need to buy between the heel and the foot. And if you look at it, I mentioned the numbers, I'd like to repeat them because they're very interesting. So, number of yards with at least one delivery peaked in 2011, 194 yards. That number is down to 101 last year, and only 37 that they had more than 5 deliveries. In terms of yards that got new contracts, it peaked actually in 2008-7 with 180 yards. Last year, that number was 27 yards that got one contract, and only 7 got more than 5 vessels. So it's actually quite interesting to see how the supply side is obviously reacting, and the governments are not there to put in billions of billions of billions of billions. They're obviously there to support yards that they feel are sustainable, and I think that's at the end of the day a very attractive risk and reward proposition if you look at it from obviously little time.
Absolutely. And do you see investors adopting that thinking? Are they kind of catching on to that story and willing to put money behind it at this point?
Absolutely. I mean, if you look at the last raises, obviously, I think momentum has gotten into dry bulk just because of that. We've seen several raises, growth-oriented raises, to buy new vessels at these levels. Absolutely. I think we will get to tankers at some point as well. I think 2017 is going to be a very interesting year for tankers, at least from an investor perspective. I mean, a lot of the negativity we're talking about is already priced in a lot of these stocks. So you want to make money, you need to buy them when they're cheap.
And Christa, I'll direct this one toward you, but I think people have mentioned there has been some emergence of the long-only investors after kind of a long hibernation in shipping. Are you seeing that, and do you think that will continue, or kind of what's the mix of investors we're seeing of late?
I think the mix of investors depends on the company and the sector, but to answer your first question, yes, we are seeing long-only investors come back for, I would say, particularly for companies which are larger, which have a good corporate finance strategy, and which have good sector dynamics. So we've raised equity for many of the LNG companies over the last 6 months, and in all of those cases, we succeeded in bringing in a very high-quality institutional shareholder base, existing investors, new investors. You still have crossover of the energy investor in certain segments of shipping, and LNG is one of them. So I think you are absolutely seeing that. And, transitioning in a bit to the MLP sector, the MLP sector over the last decade as it has grown, there's over 100 listed MLPs today. An established set of institutional investors, dedicated MLP investors have developed. Now that has been going through a period of volatility over the last 2 years with the price of oil. and the maritime MLP sector is a smaller component of that, and so their valuations have been affected. But we've actually seen over the last 6 months, several of those companies starting to trade much better, starting to have access to capital again. And if you look at early 2016, now this is taking a step back out of shipping and going to the MLP sector broadly, the average MLP investor was very much focused on balance sheet strength and ability to preserve their cash flow stability. That has shifted back to the MLP investors focusing again on growth. Now, the balance sheet still has to be there. It has to be secure. You have to be careful about refinancing risk, recontracting risk as it pertains to shipping. But investors are much more looking towards what is the company's ability to grow again. We think that's healthy, and we think that that's something that does help attract new capital.
Great. And Erik, what are you seeing? Are you seeing the MLP investors back on your
Yeah,
side as well?
I think that a year or so ago, we were all pretty down in the dumps about MLPs, and I think they really have made a great comeback. The MLP, when used in a disciplined and appropriate way, is a terrific financing mechanism for an asset-intense business like shipping, where you have a group of investors who are willing to pay a premium for a revenue stream that is both long-dated and has good counterparty risk to it. So we think it makes all the sense in the world for shipping, and we are seeing a lot of renewed interest in it. I would add to Christa's comments and say that one of the aspects of shipping is that it's a relatively narrow institutional base that owns shipping stocks. And so the emergence of a few new long-only investors or the departure of a few investors really does affect the level of interest and ability to generate demand. And so I think that they are coming back. We need more of them, and there has to be, there just has to be, as we've said it a bunch of different ways, but people have to really believe that they're going to make money in these stocks over a period of time that's sufficiently long that they can actually get in and out of their positions.
Unfortunately, however, for the MLPs, we don't have too many shipping segments that enjoy long, visible and strong cash flows. That's the challenge we have. In most of the other shipping segments, they are, apart from LNG, they're quite volatile and shorter term. So.
Yeah, and I think you don't see a lot of owners jumping to charter out their vessels at this point in time. And so to me, the MLP market is great when it's all working, right? Because I think, to Chris's point, you have to price it relative to other MLPs as well. So if midstream, and I'm not an MLP expert, but if midstream, companies are trading in, mid-single digits, right? Shipping is always going to have a premium behind it associated to it because the contracts aren't as long, the cash flows aren't as stable. And so I agree with Erik. Yes, the MLP market is an attractive financing tool for companies, but only if you really have the right profile of assets and charter duration.
We have a little time here, so we'll just cover, and maybe we can just ask everyone for what any other trends or predictions for shipping this year. Do you think we'll see an IPO this year, a traditional shipping IPO?
Well, there's certainly no shortage of people who would like to do it. It's a real. I think Todd said this before. It's where is the value proposition? And I think that. My prediction is that there will be another Quintana-like deal done this year, which I think would be very healthy. And I'm not going to stick my neck out beyond that.
Yeah, and I would just say trends on the listing side. Last year was the first time that NASDAQ, we actually had more listings on our Nordic markets than we did on our U.S. markets, which is quite, whether it's on our Stockholm market or also our First North market, and we think that trend is going to continue. We had 94 new listings last year on our Nordic markets, and right now we're actually leading again, in front of our U.S. market. So that's an interesting statistic there, as many companies are looking for listing venues, and we were quite pleased that we surpassed the London Stock Exchange last year in terms of listings.
And Joe, what kind of industries are you seeing there? Is that a lot of oil and gas, shipping? What sort of?
Yeah, it's pretty diverse. So we are starting to see now that energy is loosening up. So yeah, we definitely are seeing some energy deals. A lot of healthcare, so a lot of biotech, and I would say also a lot of technology deals are looking at our Nordic markets.
And I would agree with Erik. I think you could see, IPO by merger again this year. But I'll stick my neck out a little. I think there are investors out there that would invest in the right shipping IPO. And what's the right shipping IPO? I don't know exactly, or I'd do it tomorrow. But I think it's something that investors see limited downside in and can really see a path to upside. And so maybe it's an unlevered set of assets that were bought at the absolute, downturn in the market over the last, 12, 18 months, maybe in dry bulk. And maybe it doesn't have to have giant scale, right? We always talk about scale, and that makes a better public company. But I think there are investors out there that would be willing to, bet on, the global macro recovery and on something that has, at least limited downside, meaning it's not a mess that's been financed over the last 3 years at really high values or anything like that. So I think we could see one this year.
Well, as Joseph said, the Nordics have been actually very active so far this year. We raised the 75 million for Songa Bulk in November, and then they transited to the Norwegian Merkur Exchange, and we did a $100 million offering for them a few weeks ago. And today, Board Drilling is closing their $800 million offering to buy Transocean's jackup fleet, also on the region, over the Norwegian over-the-counter exchange. So there's definitely, activity in that regard. And obviously, at some stage they will transit to a full listing either in Oslo or in New York. But, the Norwegian over-the-counter is interesting because it obviously reduces the lead time to capital significantly. And, when there is an opportunity like Borr to acquire Transocean's fleet, you can secure the funds and get cracking, and then you can obviously work on getting the full listing later.
I think Erik makes some good points, because I would say, and I said at the beginning, there is capital out there for those who would like to find it. It may not be the traditional regular way IPO. The ship owners all get up on these panels and try to give words of warning to each other and tell everybody not to order ships. As a banker getting up here trying to do the same thing, I would say, if as the markets start to rebound, the last thing that we need as an industry is somebody doing a new IPO for a company that's not suitable for the public markets just because there's some momentum there. I think that everyone up here has an interest in bringing companies to market which are properly structured, not just for the short term, but for the long term. And when we have those situations, as Todd said, that is going to be the best recipe for an IPO.
We have 1 or 2 minutes, and I think I have a question over here, maybe.
Yeah, thanks for your interesting discussion, and it seems to be the consensus is that the industry is pretty closer to the bottom than it has ever been, and you're relatively optimistic. I was curious to know whether you put into your models, asked your crystal ball, what might happen if the United States adopts a border adjustment tax or some other sort of trade interference? Might it not affect dry bulk as much as manufactured goods? Might it affect overland Canadian, Mexican trade more than shipping? But I'd be just curious to know whether you've modeled any of this or put it into your foresight.
Well, I think a border adjustment tax is a broad term that can mean an awful lot, and at this point, it's pretty hard to put it into a model, if you will. But it obviously is a risk, and it's something that, as you know, to the extent it happens, what are the offsets that are going to create opportunities along with the factors that create problems? So the short answer is we haven't modeled anything because there's nothing yet to model. But as and when it comes up, you can be sure that we and probably more importantly, all the investors will have a point of view on how it's going to affect shipping.
Any other questions? I think we're out of time anyway, so thanks all for your time and your interest. Appreciate it.